The framework also defines important accounting terms. The individual standards take up these definitions, refer to them, or refine them where necessary. The definitions in the framework also help when there is uncertainty in the interpretation of standards. So let's take a look at it. All right, class, let's kick things off with assets. These are the resources a company controls that are expected to bring in future economic benefits. And that word, control, is super important here. We're not just talking about owning something like cash or equipment. We're talking about having the ability to use it to decide how and when it's used to generate value for the business. So think of things like inventory, buildings, or even a patent. If the company has the power to use it in a way that helps the business, it's likely an asset. But we can't just call anything an asset. There are two criteria we need. One, it has to be probable that the company will get economic benefits from it in the future. And two, its cost or value has to be measurable reliably. If either of those isn't met, nope, not going on the balance sheet. So it's not just about what you have, it's about what you control and can measure. Next up, liabilities, aka what the company owes. A liability is a present obligation that comes from a past event, and settling it will probably mean parting with some economic resources, usually cash. So things like loans, unpaid bills, or bonds the company has issued. All liabilities. To recognize a liability in the financial statements, we need to tick 3 boxes. 1. There must be a present obligation from something that already happened, like signing a loan agreement or receiving goods without paying yet. 2. It must be probable that the company will need to give up resources to settle it. 3. And, yep, you guessed it, the amount has to be measurable reliably. So just like with assets, we need evidence and reliable measurement. If we don't have both, it stays off the books for now. And finally, let's talk about the exciting part, equity. Equity is the residual interest, what's left over after the company subtracts its liabilities from its assets. It's what belongs to the owners. If you imagine the company's financial position as a pizza, assets are the whole pie, liabilities are the slices owed to others, and equity is your slice if you're the owner. Examples? Think common stock, what shareholders invest, and retained earnings, which is profit the company keeps instead of paying out as dividends. What makes equity interesting is that it's constantly changing. Profits increase it, losses decrease it. And when the company pays out dividends or buys back shares, that reduces equity too. It's like the heartbeat of the financial statements, showing how well the company is doing and how much value the owners actually have in it.